The top business stories live from the Sky News City studio. Another fall in the UK's manufacturing output as the production downturn deepens. Tesla is outsold by its Chinese rival BYD for a second consecutive year. Plus, the German discount retailers Lidl and Aldi claim they've seen record sales over the Christmas period. Good afternoon, this is Business Live with me, Ian King. The downturn in UK manufacturing production deepened at the end of 2023, according to figures published today. The Purchasing Managers Index survey, in which anything above 50 represents growth and anything below that contraction for manufacturing, came in at 46.2 in December. That was down from the 7-month high of 47.2 seen in November, and means manufacturing production on this measure has now fallen for 10 consecutive months. S&P Global, which compiles the survey data, said UK manufacturers saw a fall in new order intakes from both domestic and export clients. Well, a little earlier, I spoke to Russ Mould, Investment Director at AJ Bell, and he gave me his reaction to the PMI data.
I think they were a little bit below the preliminary number. They were down from a 7-month high in November. So in keeping with the sort of market expectations of a potentially soft landing, interest rates coming down at some stage, possibly as early as spring, and inflation cooling. So in that respect, not particularly surprising, but as a headline number, not especially encouraging. And the 10th number below the 50 level that separates growth from contraction, the last number above 50, I think, was February.
Yeah, I guess what will concern people is S&P making the point that new order intake was down very sharp.
Yeah, new orders were down, backlogs were down, jobs were down, I think, for the 13, 14, 15 month in a row. So again, it's not a particularly cheery proposition. Thankfully, it's probably not an awful lot worse than markets were discounting, say 12 months ago from the narrow perspective of investment, at least.
Obviously, manufacturing is only about a fifth of GDP, so it's a services number that we're really looking out for later this week. Any extrapolation for fourth quarter GDP?
0 point something, I guess, would probably be my guess. I mean, we've had a very, very weak set of numbers. I've got my cheat sheet here in front of me, 0.1, 0.3, 0.0, minus 0.1. If anything, it may be more consistent with a number slightly to the minus rather than the positive, which would be that technical recession that we've been fearing for a while, but equally still not a deep recession, that soft landing that financial markets have got their fingers crossed for at the moment.
Yeah, would it potentially, this number on its own, nudge the MPC towards an earlier rate cut than we're expecting?
I'd like to think not, because it's a backward-looking, again, it's a bit of a backward-looking number. The MPC, very difficult job that it has, is really trying to set the cost and the price of money for 18 to 24 months' time. That said, the MPC has said it is data dependent, so I'm sure they will be looking at this figure, but you'd like to think it wouldn't be too influential. No, I think, if anything, what they've been focusing on is probably more the inflation and wage growth numbers, particularly, rather than the output numbers. But if job numbers, if unemployment starts to rise, that would knock on to, you would expect it to jobs and therefore to wage increases.
Well, look, while we got you, Russ, obviously 2023 was a stellar year for stock markets, pretty much everywhere.
Not so much the UK, unfortunately.
The UK. What are your expectations for 2024?
I'd like to think the UK has been a problem child for many professional and retail investors for a long time. It scuffed out, what, a 4 or 5% advance in 2023. It does look cheap. It does offer a decent yield. There is the increased cash return from buybacks. There is merger and acquisitions. We have seen 30, 40, 50 listed companies bid for last year. So you'd like to think there would be something to go for there. And if the Bank of England delivers on the 4, 5, even 6 rate cuts that some surveys are now suggesting, you'd like to think that would give the UK a little bit of a lift in 2024. It's unloved, but unloved can mean undervalued, and that's always a decent starting point.
Absolutely. What about the US? I mean, obviously the S&P was up nearly 25% last year. Can it do something like that again?
The Nasdaq was up nearly 50, and the last time the Nasdaq had a 50% plus year, that was 1999, and the year that came after that was a pretty forgettable, or then a bear market started, even if it didn't really get going until 2001. 2020 was a tough year. Again, I guess you can say the market in the US, it's much more richly valued than the UK, always has been. But even relative to its own standards, it's fairly expensive. Earnings per share forecasts have been dribbling down a little bit, and you're very reliant upon this magnificent 7 collection of companies. If there's any stumbles there, and Tesla looks to be losing market share to BYD, you've got regulatory pressure on Apple, whose earnings aren't really growing very much, and it's still dependent upon a 15-year-old product. There are some issues there that could, you would imagine, weigh on the US. And if we do get some degree of optimism for the wider global economy in 2024, You'd like to think that might help emerging markets rather than the US, and they've languished very badly. And if we don't get a soft landing or a hard landing, but a bit of a crack-up boom because central banks have moved too early, that would potentially perhaps favour commodities and real stuff, as happened in the 1970s, because commodities relative to equities are, again, multi-year lows. So the middle path is what's discounted: soft landing, rate cuts, cool inflation. Therefore, Murphy's Law will probably dictate we might get something down either side, either a harder landing or a crack-up boom. And if central banks move too early, maybe it's the crack-up boom area that will be going down. The path will be going down.
Some other stories for you now. The Chinese electric vehicle maker BYD, as Russ Mould just mentioned, has sold more units than Tesla for a second consecutive year. BYD, whose backers include the billionaire investor Warren Buffett, said it sold just over 3 million vehicles during 2023, up 62% on 2022. Well, of that, 1.6 million vehicles sold were battery electric, while 1.4 million were plug-in hybrids. But Tesla remains the world's biggest manufacturer of pure electric vehicles for now. It revealed today that it sold 1.81 million vehicles during 2023. That was up 38% on 2022 and slightly ahead of Wall Street expectations. The Danish container shipping giant Maersk said today it would continue to pause all sailings through the Suez Canal and the Red Sea. The news comes after reports earlier today that it planned to sail more than 30 container vessels in the region in coming days. Well, Maersk paused all Red Sea sailings for 48 hours on Sunday after Iranian-backed Houthis sought to board one of its vessels in the region a day earlier before being repelled by the US military. The fund management giant Fidelity has reportedly further written down the value of its investment in X, the social media platform previously known as Twitter. The American news website Axios says that Fidelity, which contributed more than $300 million to Elon Musk's $44 billion takeover, wrote down the value of the investment by a further 10.7% in November, the month, of course, during which Mr. Musk publicly abused advertisers who were boycotting the platform. Axios says Fidelity has now written down the value of its investment in X by 71.5%. The German discount retailers Aldi and Lidl today claimed record sales over the Christmas period. Aldi said its sales during the 4 weeks to Christmas Eve were up 8% on the same period last year. Lidl said its sales during the same 4 weeks were up 12% on a year earlier. No like-for-like figures, which strip out the impact of new store openings, were supplied. Both said they saw their busiest ever trading day on Friday, the 22nd of December. HSBC has completed the sale of its French retail banking business. The sale for a symbolic €1 was announced as long ago as June 2021, but was finally completed on New Year's Day. The buyer is My Money Group, a business controlled by the US private equity firm Cerberus. It gets nearly 250 bank branches and 3,500 employees with 800,000 clients. The business will be rebranded Crédit Commercial de France, the original brand, but one ditched by HSBC in 2005. Now, the furniture and homeware retailer, the Cotswold Company, today hailed strong consumer demand in both online and in its showrooms as it reported solid Christmas trading. The Cotswold Company said that during the 9 weeks to New Year's Eve, net orders came in at £16.4 million. That was up 13% on the same period last year. It said this was also up 64% on the comparable pre-COVID period in 2019. Well, earlier, the chief executive, Ralph Tucker, told me where order growth had been strongest.
We've actually seen a slightly stronger trade in our showrooms this year. So we've seen overall a 13% sales growth for the business, and we are primarily online. We've seen around 10, 11% growth within our online channel, but actually in our retail showrooms, we've seen a 19% growth between kind of the end of October and the end of December.
Has that taken you by surprise?
We were very pleased with it, yes. Well, two things have kind of happened. We've put a lot of time into training our teams in the showrooms, so making sure they're able to articulate the benefits of our product. Quality is a big thing for us at the Cotswold Company. So we've seen a better conversion in store as we've kind of trained the teams up to be able to articulate why the product is better maybe than some of our competitors. But we've also done a lot of work digitally driving customers to our showrooms. We're quite a small company still. We've just opened our 9th showroom in Bath just before Christmas. And so what we've tried to do is get awareness of those showrooms up by using kind of digital channels to do that. And as a result, we've seen an 11% increase in footfall into the showrooms throughout that period.
Which lines have been selling best over the Christmas period?
It tends to be our bedroom products. So we're well known for kind of bedroom cabinetry, beds, mattresses, those sort of products. And we've seen a really good sales lift from those, and particularly in our kind of painted wood furniture. So we have 2 ranges, Chantilly and Chester, which are our biggest ranges, and they've done really well for us. But we've also seen some really great sales in accessories, which we're fairly new to. So we've only been selling accessories online and in our retail showrooms for the last few years. And we've seen some really strong growth in our Christmas lines, but also those lines to kind of get ready for Christmas. So setting the table and that sort of area.
To what extent are the numbers flattered by inflation?
We haven't actually been pushing prices this year. So yes, inflation we've seen in the marketplace been incredibly high over the year. But actually, the inflation within the kind of furniture market was really driven a couple of years ago with some of the supply chain challenges that we saw within the market. So actually, this year, our prices, if anything, and our AOV is pretty much flat year on year.
To what extent, historically, have Cotswold Company's fortunes risen and fallen in line with the housing market?
It has some impact, but actually what we do find is if consumers are moving, that's great. You know, they're buying new houses and wanting to kit those houses out. But actually, if the market kind of flattens, we tend to see consumers investing in their houses, and particularly our kind of target demographic, which is sort of ABC1, slightly older, so sort of 45 plus. We see a lot of our customers actually wanting to invest in their houses if they aren't moving. So it has a small effect, but doesn't really impact us too much.
Now, since 2016, you've been owned by the private equity firm True Capital. What are their ultimate ambitions for you?
Well, with any capital investment company, they want to gain, sell the company or drive further investment within it. So they are the aims. But what we found with True is they've been very supportive of the company over the last few years, certainly as I've been CEO within the company, in enabling us to grow profitably and invest within the brand itself.
Now, as you say, you've just opened your 9th showroom. How many, ultimately, do you think the market can take?
Well, we're going to take it, we have ambitious plans, but we're going to take it very, very carefully with the showrooms. Everyone needs to stand on its own 2 feet and needs to make profit for the company. So we take a very sort of structured view as to we open one showroom, make sure it's trading absolutely well, that the staff are trained and the awareness is good. And then we open another one, and we're hoping to open our 10th showroom within spring, but we're not flying into hundreds of showrooms, and we'll see where that takes us. But certainly we see kind of 15, 20 showrooms being more than achievable for a company of our size. OK,
and where's the 10th location?
Well, we're hoping that the 10th location will be up in the northwest of England, so near where I come from in the Cheshire region. But we're also looking at sites in and around London and in the southwest and the southeast as well.
More broadly, how do you assess consumer confidence as we enter the new year?
I think, and it's been widely reported that consumer confidence is still very tough out there. We're still seeing the impacts of inflation, as you've already raised, but we are seeing customers willing to invest in purchases of high quality product. And as you know, we've had some great results over the Christmas period, and I think a lot of that is about consumers maybe, or certainly our consumers, turning towards less throwaway furniture and maybe investing in product for a longer period of time. So really getting value out of the product that they're buying and wanting that value from that product.
Bit of breaking news to bring you. Obviously, there are storm warnings in effect over much of the country right now, and the Energy Networks Association, which collects data from all energy providers, has just said that around 8,900 homes are currently without power. The majority of those are in the southwest of England. We'll have more on that throughout the evening here on Sky News. Meanwhile, some more breaking news to bring you, this time from the Middle East. The Lebanese TV station Mayadeen TV, which is a pro-Hezbollah, pro-Iranian TV station in Lebanon, is reporting that Saleh al-Arouri has been killed. He is the deputy head of Hamas, apparently, and according to this TV channel, he has been killed in an Israeli drone strike. We will have more on that news as well here on Sky News later on today. In the meantime, still to come here on Business Live, we'll have a look at how the markets have done this first trading day of the new year. Don't go away.
Big stories don't always come from big cities. I'm Lisa Dowd and I'm Sky's Midlands correspondent, and this is where I grew up. We can reveal that the driver who hit Harry Dunn is 42-year-old Anne Sakulas.
Just met the president and we never thought we'd get this far.
This is what they're up against. The wind is the really big problem. It is back-breaking work and the smoke is thick. It's been working well. Water levels are dropping, but no one knows what impact further rain will have. What would you do if this place wasn't open? We take you to the heart of the stories that shape our world.
It's really scary. We're terrified.
In this community, I'm told that everybody knows someone affected by COVID.
Hopefully this will be the last wave.
I never knew they would make it. It's amazing.
Change seems tantalisingly close in this corner of the UK. Wales was the first to introduce the plastic bag charge. This is my patch, my specialism. It's also my home.
Fly Emirates, fly better. Fly Emirates, fly better. Thank you.
Well, the US dollar has enjoyed its biggest one-day gain since October, ahead of the US jobs figures out later in the week. On the other side of those trades has been the euro and the pound. Sterling off by nearly 0.4% on the session against the dollar, more or less unchanged against the euro. The single currency, meanwhile, similarly down by nearly 0.4% against the dollar. On the equity markets, well, European stocks began the new year positively, but those gains drifted away as the session has gone on. The CAC 40, actually in Paris, has finished in negative territory. Talking points today include the French food group Danone. That's finished up ahead by 1% in Paris after selling its US organic dairy units. Well, here in London, the FTSE 100 earlier finished, it's hit a 7-month high earlier on, but it's finished around 1/6 of 1% lower. Gains for some of the big dollar earners have been balanced out by losses in financial stocks. Among the leading blue chip gainers today has been Marks and Spencer, finished up nearly 1.5%. That's on positive broker comment and hopes that it's enjoyed a good Christmas. The Asian-focused insurer Prudential has led blue chip fallers off nearly 3.5%. Outside the FTSE 100, well, Babcock has led the mid-cap gainers, up by more than 6%. That's on hopes it will continue to benefit from increased defence spending. To the downside, the cybersecurity firm Darktrace is a leading mid-cap faller. Over on Wall Street, well, the main indices all opened to the downside. As you can see, Nasdaq is off nearly 1.5%. Dragging on both the S&P and the Nasdaq is Apple. That's currently off by some 2.5% after analysts at Barclays downgraded their earnings forecast and tell you the Dow Jones has just nipped into positive territory in the last couple of minutes or so. As for the oil price, well, that traded higher earlier in the session. It's given back all of those gains and more. Barrel of Brent crude will currently set you back $76 on the nail. That's off just over 1.33% on the session. Joining me now is George Lagarius, Chief Economist at Mazars Wealth Management. George, Happy New Year to you. Let's start with Tesla, because really quite interesting. The FT is actually reporting that it's been overtaken by BYD. It hasn't. BYD outsold it last year, but Tesla remains the biggest pure electric vehicle maker.
Yes, but by a whisker. And ultimately, this is all about the Chinese market, right? Or at least most of it anyway. It's about the Chinese people buying Chinese-made vehicles. And if anything, this signals the end of, Chinese forecasting, which is going to be the next big European company, China. It's going to be Chinese company. So I think this is really what the story is telling us.
That's interesting. We talked earlier in the programme about the UK manufacturing PMIs. The Eurozone numbers were, if anything, even worse than the UK's.
Yes. Having said that, we are seeing evidence in Europe, and I think this will translate in the UK as well, that we have bottomed out. Obviously, Europe has been in contraction for 18 months now, more or less, but we are seeing some evidence that new orders are sort of slightly picking up. Also, in the good news of the day, Greece was the only European country which saw its manufacturing expand.
What's driven that, George?
Just really the base effect. We don't have much of a manufacturing production going on, so it's easy to expand from where we are.
Well, it's nice to have a bit of positive news, I guess. What about the oil price? I mean, that's really been very largely unmoved by recent events in the Red Sea. I mean, I guess the market's been quite quiet over the Christmas and New Year period.
Well, yeah, so there is a little bit of that. The market has been sleepy, but also if we haven't heard from OPEC Plus, we are unlikely to move, because right now the bigger story is that American shale companies are producing more and balancing out some of the recent OPEC cuts. So unless OPEC gets more aggressive, which they are likely to if they want to make more money, then we wouldn't likely see the oil price change. So it's all in the OPEC's hands.
Interesting that you alight there really on the supply side. What do you think is happening on the demand side right now?
Well, on the demand side, it's difficult to gauge, but overall economic activity is slowing as we enter Q1 2024, and it's sort of the same thing in China. We haven't seen any meaningful pickup. You said manufacturing data is competing between Europe and the UK for which is more dismal. So, and in America we are seeing a slowdown too, but. That's Q1. Going forward, you could see a pickup in demand mid-year.
George, what do you make of this strength in the dollar today? I mean, obviously the big trade in the tail end of last year was all about interest rate cut expectations. Are those bets unwinding to an extent?
Well, they should be at some point, but the markets have gotten way, way ahead of themselves. The Fed dared to utter 3 rate cuts, and suddenly, the next moment, the markets are pricing in 6 rate cuts. So, you know, something's got to give, and obviously markets need to calm down a little bit. And I think that's what today's dollar trade is reflecting.
And George, very briefly, if you would, please, any changes in expectations as far as you're concerned about the ECB?
No, we expected the ECB to be more hawkish. They delivered a more hawkish message, and we expect that they're going to be careful and conservative with inflation. And unless they see a meaningful slowdown in inflation, they're not likely to cut rates anytime soon. OK,
George, got to leave it there. Good to see you this afternoon. Thank you. That's it from me for today. Back at 11:30 tomorrow. I hope you can join me for then. Up next, it's the News Hour with Mark Austin. Much more on that breaking news concerning Hamas's deputy leader. Stay tuned.